It is a three-digit number that essentially controls your financial destiny. It decides if you get the house, what car you drive, and, crucially, how much extra money you pay in interest every single month. But for most people, the credit score is a black box. You swipe a card, you pay a bill, and the number goes up or down, seemingly at random. Today, we are cracking the code. We aren't just talking about what a credit score is, we are going deep into the math. Specifically, the FICO algorithm. We will also tell you the biggest myths about your credit score. By the end of this video, you won't just know how the score is calculated. You'll know exactly which levers to pull to manipulate that score in your favor. If you're ready to stop guessing and start scoring, smash that like button and let's get into it. First, a quick clarification. Not all scores are created equal. You might check your score on a free app and see one number, then go to a mortgage lender and they pull a completely different number. Why? It's because there are two main scoring models, FICO and VantageScore. FICO, used by 90% of top lenders. This is the one that matters for mortgages and car loans. VantageScore, used mostly by free credit monitoring sites and some credit card issuers. Today, we are focusing on FICO 8 because that is the industry standard. The score ranges from 300 to 850. Anything above 740 is generally considered very good to excellent. Below 580 is considered poor. The higher the number, the less risky you look to a bank. But how do we get to that number? It's broken down into 5 specific categories. Let's look at the biggest slice of the pie. 35% of your score is payment history. This is the "do you keep your promises?" category. Lenders want to know, when you borrow money, do you pay it back on time? This includes credit cards, retail accounts, installment loans, like a car or student loan, mortgages. If you miss a payment, the damage is calculated based on 3 things. Recency, how long ago was the missed payment? A late payment from 5 years ago hurts much less than one from last month. Frequency, did you miss one payment, or do you miss them every other month? Severity, did you miss it by 30 days? 60 days? Or did it go to collections? Pro tip for credit and cash viewers, a payment is not technically reported late to the bureaus until it is 30 days past due. If you are 5 days late, you might get hit with a late fee from the bank, but your credit score is safe, as long as you pay before that 30-day mark hits. Next up, weighing in at 30%, is amounts owed, often called credit utilization. This is the part that confuses people the most. It is not just about how much you owe, but how much you owe compared to your limit. This is a ratio. Let's do the math. If you have a credit card with a $10,000 limit, and you have a $5,000 balance, your utilization is 50%. That is high. FICO gets nervous when this number goes up because it looks like you are overextending yourself. You've probably heard the 30% rule. Keep your utilization under 30%. But here is the secret. Under 10% is where the 800+ credit scores live. Crucial note, utilization has no memory. This is the only factor in your credit score that resets every month. If you max out your card today, your score drops. If you pay it off tomorrow, your score shoots right back up next month. If you are looking for a quick way to boost your score before a loan application, paying down balances is the fastest way to do it. Coming in at 15% is the length of credit history. This is the seniority factor. FICO looks at 3 time metrics here. Age of your oldest account, age of your newest account, the average age of all your accounts. This is why we always tell you on this channel, do not close your old credit cards if they have no annual fee. If you have a card you got in college 10 years ago, that card is anchoring your credit age. If you close it, you lose that history, your average age drops, and your score could take a hit. Keep it open, buy a pack of gum on it once a year, and put it back in the drawer. Now we have new credit, which accounts for 10%. This is where hard inquiries live. Every time you apply for credit, whether you get approved or not, the lender does a hard pull. This usually dips your score by about 2 to 5 points. 1 inquiry? No big deal. 6 inquiries in a week? You look desperate for cash, and that makes you high risk. The exception? Rate shopping. If you are shopping for a mortgage or an auto loan, FICO groups all those inquiries into one, provided they happen within a 14 to 45-day window. So don't be afraid to shop for rates. The final 10% is credit mix. Lenders like to see that you can handle different types of debt. There are two main types. Revolving credit. These are your credit cards. The balance goes up and down. Installment credit. These are loans with a fixed end date, like a car loan, student loan, or mortgage. Having both shows you are a well-rounded borrower. However, never go into debt and pay interest just to improve this 10% slice. It's a bonus, not a requirement for a good score. Let us do a brief pause to clear up a few common myths. Myth number 1. Checking your own credit hurts your score. False. Checking your own credit is a soft inquiry and has no impact. Myth number 2. Carrying a balance helps your score. False. Interest does not improve credit scores. Low utilization does. Myth number 3. Income affects your credit score. False. Your income is not part of the scoring formula. And finally, myth number 4. Closing credit cards always helps. False. It can increase utilization and reduce credit history length. So, there you have it. Now it is time for Remember You, the formula for the perfect score. Pay everything on time, every time, 35%. Keep your balances low, 30%. Keep your old accounts open, 15%. Don't apply for too much stuff at once, 10%. Mix up your credit types naturally over time, 10%. If you found value in this breakdown, do us a favor, hit that like button and subscribe so YouTube knows this is a good info. Let us know in the comments which of these 5 factors is dragging your score down right now.
This is Credit and Cash. We'll see you in the next video.